The following is a production of Texas Lutheran University. For more information, please visit tlu.edu.
We're representing Bulldog Investment Company, and we're excited to share with you today our investment philosophy, decision-making process, and a review of our long-term investment results. This is the presentation we submitted to the Texas Investment Portfolio Symposium. Over 40 of the top undergraduate and graduate programs in Texas, Oklahoma, and Louisiana applied to have their portfolios chosen as the best in the region. Not only were we selected as one of the 6 finalists, but we placed in the top 3. The judges were current investment professionals, and they were supposed to judge us on our ability to manage a portfolio. Is this working? All right. Well, sorry about that.
Need some help there?
No, I got it.
Don't get those huge.
Yeah, that's an inside joke there. So we are a student-managed portfolio with a bottom-up value investing philosophy, and much of what we do is based on Warren Buffett's management style of today and of the past. Established in 2009, Bulldog Investment Company promotes critical thinking and the ability to read and interpret financial statements. By utilizing these tools, we believe we can find sound, logical investments that will outperform the market as a whole over time. We split into 2 teams each semester in Bulldog Investment Company, and 3 times a semester, we present our best investment ideas against each other, and then the winning presentation is chosen by a board of directors, and then that stock is put into the portfolio. Then throughout the semester, we all closely monitor our portfolio for any changes on any selling or buying opportunities. As value investors, we leave open the possibility of any of the 5,000 public stocks that trade daily in the United States. In doing so, we look for 4 major types of investments. First, we have our traditional, long-term, Warren Buffett-like investments. Next, we have certain criteria for cash-out arbitrages, and we consistently look for the opportunity to participate in these. Also, we use option contracts to identify strategic entry points. And then finally, we believe there are times when the market misunderstands and then subsequently misprices a company. And as value investors, we can block out the noise of Wall Street and evaluate the company for ourselves.
Okay, so Ernie briefly introduced the different types of strategies that Bulldog Investment Company uses. I'm going to further outline our long-term decision-making strategy. So first, we look to see whether the company is easily understandable and predictable. If it's not, how can we value it going forward? We then look to see whether the company has a sustained competitive advantage, if a protective moat exists. Finally, we look to see if there is a considerable value gap that we can take advantage of based on how the market has priced the stock. We do this using historical valuations and a discounted cash flow model. One such investment that met these 4 criteria was Advance Auto Parts. Advance Auto Parts is a specialty aftermarket automotive retailer of automotive parts, accessories, batteries, and maintenance items. It is a parts store, an easily understood company. As far as predictability, these are just a few of the many metrics that we analyze. Return on equity is important, as it is not only Warren Buffett's favorite ratio, but it is a measure of how effectively a company uses income to increase shareholder wealth. Over the past 10 years, Advance Auto Parts' return on equity has not fallen below our 15% threshold. Free cash flow has been increasing, and additionally, the company has bought back approximately 35% of its shares outstanding, in essence giving investors a larger ownership in the corporation without their purchasing of additional stock. Advance Auto Parts has an extensive network that works to serve the retail customer as well as the professional. This network effectively provides for customers while keeping competitors from entering the market. Finally, we noticed that Advance Auto Parts was trading at near 10-year lows for price to earnings, price to free cash flow, and Schiller PE. We decided it was a good time to invest. We entered Advance Auto Parts at $70.11 per share on October 5th of 2012. Since adding it to our portfolio, it has gained approximately 78%. I'll now look at a few of our other long-term holdings. IBM, Walmart, Coke, these are just a few of the more well-known companies that we have in our portfolio. Many people think that long-term investing, value-based investing, is difficult and complex. Really, it isn't. It simply comes down to finding a company that you understand, that is predictable and consistent, has a strong brand name or quality that gives it a sustained competitive advantage, and finally, having the discipline to wait to purchase the stock at a price that is attractive. Ernie will now discuss cash-out arbitrage opportunities.
A cash-out arbitrage begins when one company buys another, and Warren Buffett has 4 rules for participating in these. First, it must be an all-cash deal because we know what we're getting with cash. It doesn't fluctuate like the price of stock. Also, it must be a friendly buyout so that we know that the management of each company is on board with the deal, so there's a likely chance of the deal going through. Next, there must be few regulatory hurdles so that we know the Department of Justice or any other governmental agency won't block the deal. And finally, and most importantly, there must be a significant market price discount to the final cash-out price. This creates a value gap which we can take advantage of. We participated in a cash-out arbitrage in August of 2011 whenever Google announced its acquisition of Motorola Mobility. The deal was announced at a buyout price of $40 per share, but in February of 2012 we noticed that Motorola was only trading at $38.25 a share. This is that value gap that we're talking about. So we entered in at that price. As we suspected, the deal was completed in May of 2012. By participating in this investment, we got a gross return of about 4.5%, but because of the short holding period, we had an annualized rate of return of almost 16%. So here you can see the 6 cash-out arbitrages in the rates of return that we have participated in Bulldog Investment since its inception. You can see that the average annualized rate of return for these deals is about 26% with a holding period of less than 2 months. The size of our portfolio lets us participate in these lucrative deals that many larger portfolios are not able to. As such, Warren Buffett used to do a lot of these whenever he was first starting off. These deals, because of the short holding period, allow us to efficiently add cash into our portfolio.
Thank you. Well, our first 2 strategies, long-term holdings and cash-out arbitrages, are types of investments. Our third strategy, put option contracts, is more of a tool that we use to create effective strategic entry points into these investments. So an excellent example of how we use put option contracts came in November of 2009 when Procter Gamble was presented as a potential investment. The week prior to the presentation, after the team had already evaluated, already analyzed, and already determined that Procter Gamble was the company we wanted, the stock price rose 6.5% to $58.58. But while we wanted this company, we didn't want them at that price. So rather than chase the short stock spike, we decided to write a total of 4 put option contracts over a span of 6 months. What this did was create an aggregate of $5.45 per share. And when the 4th put option contract triggered at a strike price of $62.50, we effectively lowered our entry point from the strike price minus the premiums to just over $57, which is over $1.50 in savings than it was 6 months prior per share. Bulldog Investment Company, since inception, has participated in 45 put option contract transactions. And what the premiums from these transactions has allowed us to do is create an aggregate of cash of $5,775, or just over $1,300 per year. On average, our participation and our strategy with put option contracts has created just over 3.5% in returns every year.
All right. Now, as value investors, we're constantly looking for the opportunity to find an asset that is mispriced by the market, whether it's due to an overreaction or simple misunderstanding of what the company is. We can tune out the noise of Wall Street and better determine what we feel a good intrinsic value is based on the numbers alone. A perfect example of this is American International Group, or AIG. Now, the struggles of AIG are well documented. It underwent the largest corporate American bailout in American history in 2008, with the Federal Reserve taking an 80% ownership of the company. Negative headlines swirled around Wall Street as the asset was priced like it could forever be toxic. As we continued to do our research, just 4 short years later, we began to notice that AIG was ranked first or second in every market, in every category in which it did business. Although we had heard all these negative stories about AIG, we thought this list at least merited more research. So we decided, okay, let's ignore what they're saying and let's find out what we think AIG should be worth. So what we noticed was an interesting trend. AIG, since the 2008 collapse, had liquidated 97% of the derivatives on their books. They began to sell off non-core assets and became a much simpler, much more easy to understand company. All that they did was focus on insurance, which is what they do very, very well. Moreover, during the 2008-2009 recession, the Federal Reserve bailed out several companies. The AIG bailout was the only company that paid back the entire principal on time with interest. When it was all said and done, the Federal Reserve actually made a $22.7 billion profit on the AIG bailout. As we continued to comb through the 10Ks and the research, the articles that were out there, we began to notice something else. Because AIG had gone through a bailout rather than a bankruptcy, and therefore didn't have to discharge any of its carry-forward tax losses in bankruptcy court, AIG still had billions of what we consider to be assets on their books. Although this does not appear on the balance sheet like a traditional asset would, again, through our research and through our time, we were to find that these, to this day, they total $35 billion, and at the time of the purchase, they were almost near $100 billion in carry-forward tax losses. This is going to provide a competitive advantage going forward that they can exploit in the future. Now, despite what AIG was in 2012, the asset was priced at $34 a share, while it had a tangible book of $60 a share. So on November 2nd, 2012, we purchased into one of the world's largest insurance companies at a 43% discount to tangible book. Now that is a deal we will make every day of the week. Now, we've clearly outlined the types of investments we go through, whether they be the long-term holdings, the cash out arbitrage, the put options, or these systemic valuation gaps that we find in the misunderstood company. But that's just half the story. The other half is, what's our sell process? Now, as value investors, we realize that high turnover leads to inefficiencies in a portfolio. So the first three things I've listed up here are just kind of warning signs. And they don't tell us, oh, we need to panic, we need to sell today, we need to do anything like that. What they do instead is they suggest, okay, you guys need to do some more research, you guys need to dig a little deeper and find out what's going on behind these numbers. Now, there's three things we look for. First, we look for historically high valuations. Any company can become overvalued, so we have to monitor that at any time. Second, we look for substantial increases in leverage. As students of history and of finance, we recognize that the downfalls of great countries and of great companies happen when you leverage too greatly and you take on too much debt that you just can no longer sustain. Lastly, we look for decreasing profitability, whether they be net or operating margins. Now, this suggests that for some reason the company is losing its competitive advantage and again merits more research. Now, while doing that, we always have to remember two things. One, any company can become overvalued. In 1999, and Warren Buffett talks about it in hindsight, Coca-Cola was trading at 45 times earnings. He regrets not selling Coca-Cola. It was a great company, and it is a great company, but it was just dramatically overvalued at that time. So that's a mistake that we wish not to make. Lastly, you cannot fall in love with any company. Just because it was your first company or just because it's been your best performing company doesn't necessarily dictate what's going to do in the future. So you have to keep in mind, okay, I cannot fall in love with this company. And that's one of the things we talked about with actually this next example. Church & Dwight was actually the first company that we invested in the Bulldog Investment Company. In 2009, October 2009, we purchased Church & Dwight at $28.03 a share. Now, what this graph is showing is the price to earnings metric, and then on the green line represents the 25% threshold. Anytime you see the yellow line dip below the green line, it's trading at the bottom 25% of price to earnings metric. Anytime it's above the red line, we're talking about the top 25%. So below the green line, that's kind of a lucrative time to buy, and at least we're going to do more research to find out what's going on behind it. In between, we consider that kind of a holding period, and above, when it approaches red, we consider the company to be approaching overvalued. So just kind of goes through there. And we can see here, Church & Dwight is a great company. They have great household brand recognition. They make Arm & Hammer, OxyClean, just brands that you know and even recognize at your house. So we understood that it was a great company, which is why we invested in it in the first place. But we saw that it was becoming to get overvalued. And price to free cash flow tells the same story. Over the last 10 years, you can see we purchased in near a 10-year low. You can see it's coming near a 10-year high. And then lastly, we looked at enterprise value. And I say lastly, this is just the last one. We went through many, many different metrics. We looked at the growth opportunity going forward, and we just didn't feel that there was growth that substantiated these valuations. So you can see we bought it in at 2009, near a trough, and we sold out near a peak. Now, obviously, you can see that it's gone up since then. And you might say, oh, you guys missed the opportunity to make a little extra return, which we did when we collected dividends and we looked at the capital gains. We made 115% on this investment. But we have a saying in Bulldog. We'd rather be approximately right than exactly wrong. So we want to build in a margin of safety, and in doing so, we leave and we feel companies begin to become overvalued. Now, the real question is, how have our results worked? and has the strategies that we've implemented worked over time. Since the Bulldog Investment Company was created, the S&P 500, which we consider to be our benchmark, has returned 71%, or 13.9% on an annualized basis. Over that same period of time, the portfolio that we have managed has produced 111% on an absolute basis for an annualized rate of return of 19.6%. One of the things we always like to say is, let the numbers tell a story. And we feel that these tell a very powerful story of how logic and discipline and identifying companies that are easily to understand with a sustained competitive advantage outperform the market and other portfolios over long periods of time. I'd like to thank you for your time this Friday morning. If you guys have any questions or comments, we'd love to hear them at this time.
One of the things I saw early on in your cash out arbitrage, maybe I misread the company name, but it looked like the bottom one was a Chinese company. Did I catch that correct?
That's correct.
So you do look at stuff outside the United States? Or was that a U.S. acquisition of a Chinese company?
I think they traded in the U.S.
They traded on the U.S. stock exchange, yeah.
Okay.
It's not necessarily that they're going to the overseas market.
Do you make any hedging investments to guard against a downturn?
Like in terms of writing option contracts, or?
Sure. Yeah.
No, because we feel that our best hedge is entering in that attractive price into companies that have great competitive advantage at historically low valuations. So no, we don't use any use of derivatives that are, like, we don't sell calls, anything of that nature that would do that. But what we do is we constantly monitor our portfolio, and if we feel the company, like if we feel so strongly that the company might dip it that much in stock price, then maybe it's time to sell the company rather than get downside risk on it.
Would you share your PowerPoint presentation with the rest of us? Very well done.
Oh, thank you, sir. Yes, sir, absolutely.
My director to you website.
Oh, yes, we do have a website up. It's one word, BulldogInvestmentCo.com.
How many companies do you invest in and divest from on an annual basis?
I think in the entire history, the 5-year history of Bulldog Investment, I think we've sold 5 companies that have entered our portfolios. Like I said, it's a very low turnover.
Because you're a value proposition.
Yes. So it's a very low number. I think, like I said, I want to say it's 5. And we are currently invested in 22 different companies. Yes, sir.
Okay, this isn't an investment question, but how long is the tenure of your employees at this company? How long are you guys in the, of course it comes from the marketer. How long are you guys participating in the investment company?
It's a semester-long internship, but you're welcome to stay for as long as you're a student. So we've had students who have been in the internship for 3.5 years, 7 semesters. And then we've also had students who have been in 1 semester. That's the range. On average, I'd say that students are in 3 to 4 semesters.
And usually those 3 or 4 semesters end in graduation. I can think of maybe 1 or 2 people that have not completed. Like when you get into it, something that we obviously enjoy doing. We enjoy talking about it. It takes over kind of what you do. So we all really enjoy it. And so it's a commitment that I plan, and I know Bravo's graduating, so we plan to keep through graduation.
And how many of there are you?
13.
12, 13 right now.
So I asked this question a day before you guys came in here, but how do you think this has helped you in preparing for whether you're going to do this as your career or whatever career? How do you think this has helped you? Just kind of each one.
I think one thing Dave tries to really get across is that this isn't for finance majors. I mean, out of the 4 of us standing up here, one of us is a finance major. So I think you might be the only finance major in it right now, a couple accounting majors. But he says that the ability to understand financial statements is something that you carry throughout life that will always be helpful, whether you end up having your own portfolio, whatever you do, but just to be able to understand maybe a company you're working for, a company you're looking at. So that's something that is super helpful. And also, I think we put it on that first slide when we talked about what Bulldog Investment Company is, but presentation skills. That's been one of the biggest things for me is, I mean, 4/5 of my college presentations have been Bulldog Investment Company, so I mean, it's been, a lot more practice than maybe, just a couple. So I think presentation skills are the biggest and what he tries to stress, and then just for, finance or accounting majors, but the ability to interpret financial statements and we'll just go so far. So that's something.
It's nuts. It's different than a classroom, like the pressures and that you see. I know, and this was an extreme example. We actually for the Texas Investment Symposium, we found out 1 week before. So I was actually at my house. Dave calls me up. Hey, you gonna make this application or not? Like, we need to get this done. I say, okay. So we busted the application on 3 days. Yeah. So we put this together. I went to Dr. Sister, asked her to proofread it. She made some jot downs, but it was fast paced. So it gives you a different dynamic. And the expectations are incredibly different, and the feedback's different than what you'd see in a traditional classroom. And I mean, Dave and Nate and JC do a really great job of that.
You should have told them there were no accountants in the group. Because so many of them can't read a financial statement.
From other schools.
What are the majority of degrees that the groups want?
It's probably business majors, but
Yeah.
maybe not, finance. Personally, I'm a double major in math and economics.
I'm a management major.
Finance and economics.
Information systems.
Even here, it's just very diverse.
So a finance guy, for you, how many hours of accounting have you taken?
How many hours of accounting have I taken? I want to say 12, 15.
Okay, and based on what you've been learning here, is that enough or is it too little?
I mean, supplement it with what we're doing here. I think it's, I mean, I don't have no desire to become an accountant, so. Me personally.
I understand that. The issue is on what you talked about is understanding financial statements. And that's, out of curiosity, I'm just wondering if you think you've taken too much or too little as far as accounting to get to that point. You, as a student in investments, you have been exercising, which most students in finance don't get to apply what they have been doing until they graduate. So you can give us some feedback as to how we're constructing our program. Is it deficient or is it,
To be honest, it's incredibly difficult for me to answer that because I joined this
This
at the same time.
professor is sitting in the room, so.
I joined this at the same time I was doing my accounting classes, so I kind of learned them supplementally. It wasn't just because I entered in, I think, my third semester at TLU. So I mean, I've seen a lot of Dave and I've seen a lot of the accountants. Or so I kind of learned at the same time. It's kind of hard to separate what I've learned in the classroom and what's been taught as part of this internship opportunity.
But I think definitely, like you were saying, being able to apply it helpful because you might go to the class and then forget it. But I've just taken 6 hours of accounting. But being able to continually be in Bulldog Investment and continually applying it is much more helpful than maybe if I haven't taken it since 4 semesters ago. I might have forgot a lot of what I've done. So being in Bulldog definitely supplements it very well, like I was saying. So.
The finance specialization has 16 hours of required accounting as a part.
How many of those 16 hours of accounting, though, even talk about financial ratios?
I don't teach them, so I can't tell you.
That's what I've seen a lot of times is you'll hammer accounting. You might get into, my recollection for me was one chapter and one text in my accounting class. And it was one of the advanced courses. So that's my concern. Accounting was, it's good to get accounting, but you need to apply some of this. And this type of program is excellent for anybody.
Pamela's leaning around to see you there, so she's listening.
In the second level of principles, the second principles class, we do a financial statement analysis project, which gives them the opportunity to begin analyzing financials and using ratios. It's going to take them about 3 weeks. It's 10% of your course grade. Now, I don't claim that I turned them out to be able to do this. That's the beginning building blocks.
Oh, really?
So we start that soon.
That's excellent.
Okay.
That's the first 3 weeks of the finance class that's follow on to that semester.
I mean, for the guys that actually write these things, I mean, the accountants in the room, I mean,
biggest thing that you guys need to do is understand risks that are coming out of these financials. So you can put a bunch of numbers in something, but reading MD&A, listening to earnings calls, that's in my mind where I think you can actually listen to CEOs and what they're not saying and start to think about it from that way. Because you can run a bunch of numbers, but you can have some guy listen and start talking. But it's really understanding risk around these companies and what puts these financial statements. I put these things together. I know what we're not saying in here. And so really trying to find that and listen to that is as you guys advance in your careers, is really beneficial to getting outside the numbers and don't think he's so linear.
I was really interested in what you said about the deferred tax asset.
Yeah.
A lot of people would miss that and understand that all balance sheet value.
Right. We agree. I mean, we certainly begin with a quantitative analysis to say, what companies are even in the running for something that we want to invest in. But we do due diligence, and we look at the qualitative aspects of the company and whether or not we always read the MD&A, and you'd be, like you said, it's amazing what you find in there and how valuable that information is. So we do a thorough qualitative analysis as well, and it's incredibly beneficial, like you said. Yes.
When are you going to start selling this advice to the EAC so we know when to buy?
Yeah. Everybody has some loans.
Students at TLU engage in high-impact educational experiences that include civic engagement, aesthetic expression, critical thinking, and a focus on intercultural knowledge in a community that welcomes the interplay of faith and reason.